SpaceX, OpenAI, and Anthropic are three of the most talked about companies on the planet right now. SpaceX's IPO goes live today, and over the next few months, OpenAI and Anthropic are expected to go public too. Combined, they could represent close to $4 trillion in market value when they list, which is an insane value for anything to make its debut on. To put that in context, SpaceX alone is expected to raise more at IPO than any company in history. More than Saudi Aramco in 2019 and more than any single .com era listing. So the question on a lot of people's minds right now is, should I buy in? We manage over $4.4 billion for over 10,000 clients. And I've seen what happens when intelligent, successful people let excitement drive investment decisions. And in this video, I'm going to walk you through why these IPOs are different to anything we've seen before, what the data says about IPO performance over time, and what the smart approach looks like if you're thinking about putting money in. So let's get to it. Section 1, the reason everyone is excited is real, but the opportunity is not what you think it is. Amazon went public in 1997. Its market cap at IPO was roughly $440 million. That same company is worth around $2.5 trillion today. Now, if we have a look at SpaceX, it's expected to go public at somewhere between $1.5 and $2 trillion. It's not going public as a young company with everything still to prove. Is going public at a size that Amazon took 25 years to reach. In fact, SpaceX is over 20 years old itself. So here is why that matters for you as an investor. When Amazon listed in 1997, the price was low because the outcome was uncertain. When SpaceX lists, the price will already reflect enormous expectations about what the company becomes. The upside is priced in before you buy a single share. That doesn't mean it cannot go high. I'm not saying that. It might, but you are not getting in early. You are getting in at a price that assumes the future is already going to go really, really well. And SpaceX is not unique in that way. Every IPO has this problem. So the companies are extraordinary. The question is whether the investment is. And to answer that, we need to look at what the data says about IPOs as a whole. Section 2. The history of IPO investing is not the story the media tells. Facebook's IPO in 2012 is probably the most famous example of this. The hype was unlike anything the market had ever seen. Everyone wanted in, including me. 6 months later, Facebook was trading considerably below its IPO price. Long term, of course, we know now it went on to become one of the best performing companies in the world. But the people who bought on day one were underwater for the better part of a year. The real question is, could you keep your head if or when this happens? There's also another quirk, and this is not an exception. This is the pattern. Research going back to the 1980s consistently shows the same thing. IPOs underperform the broader market over the following 3 years after listing, and by a significant margin. There is even an ETF that's tracked IPOs since 2013. In that time, it's returned around 8% annualized. The S&P 500 over that same period has returned around 14%. And the IPO ETF had a drawdown of nearly 70% in 2022, more than double the S&P's fall in that same period. So why does this happen? Because when a company goes public, insiders typically start selling. The excitement is real, but you are buying at the point of maximum enthusiasm, and that enthusiasm is already unfortunately priced in. So what should you do? Because avoid all IPOs is not going to be the right answer either. The right answer is about how to think about your portfolio, and that is the part that nobody explains clearly. You probably already have more exposure to these companies than you actually realize. I speak to clients regularly who feel like they're missing out on something. SpaceX is going public. OpenAI might follow later this year, as well as Anthropic. And there is a voice in the back of their head that says, if I do not buy in now, I will watch this from the sidelines and I'm going to miss out. The technical term, as we all know for this, is FOMO, and it's one of the most expensive emotions in investing. So here is what the voice does not tell you. If you hold a broad index fund, you will likely already have indirect exposure to these companies. Amazon and Google have both reported significant investment gains tied to private stakes in AI companies. Nvidia holds positions across a huge portfolio of them. When SpaceX and others eventually enter the major indices, which could happen within weeks or months of listing given their size, investors who've bought into that index will own them automatically. SpaceX, OpenAI, and Anthropic together represent somewhere around 5% of the entire US stock market at current valuations. That's a huge number. So if you were to put 30% of your retirement savings into one of them, you'd be taking on a concentration of risk that is 6 times their natural weight in the market. And that is a gamble, not a bet. And at this stage of building your wealth, there is a meaningful difference between the two, as we know. The data suggests that staying diversified, staying in the market and letting these companies enter your portfolio naturally is the higher probability winning path. Here is what I want you to take away. These are extraordinary companies. The technology is real, but investing is not about finding great companies. It's about buying them at the right price with the right expectations and holding them inside a plan that is built for your life, not built for the headlines. The people we have worked with who have built serious wealth over the last 30 years were not chasing IPOs. They stayed patient, they stayed diversified, and they kept their focus on where they actually wanted to end up. That is what good retirement planning actually looks like. Not watching the ticker, but actually building the life you want to live. If you want to talk through how your portfolio is positioned and whether your exposure to these trends makes sense for where you are heading, the link in the description will take you to a conversation with a regulated financial planner. If you found this video useful, please subscribe to the channel, give it a like, and thanks very much for watching.